meeting. This is the part of the meeting where you guys get to ask me the questions you want to. All and any questions are welcome. Don't worry about asking any difficult ones. The only thing I can't guarantee is that I answer all of them. This is my favorite part of the meeting. I love talking about my companies and getting to hear what's on your mind. I think last year it felt at times like 70% of the questions were about Facebook. And Facebook was the best performing stock in the portfolio last year, so there's obviously a lot of wisdom in this crowd. So I'm curious about which areas are going to be the focus this year. So any question is welcome. One small caveat: tomorrow the entire day is going to be dedicated to questions around starting a fund, how I got started, the types of questions you should ask yourself before starting a fund. So I would save those questions for tomorrow. And then one final point: I had the great privilege last autumn to have a dinner with Charlie Munger, which was a wonderful experience. One thing which I noticed, though, the format was very much like a Berkshire Hathaway shareholder meeting, where I got to ask Charlie a question, and then he would respond, and then the next person would ask a question, he would respond. And there were a few occasions where I would have loved to have kind of pushed back or added to something to what he wanted to say, and I don't want to make that mistake with this meeting here. So there's no obligation to follow up to my response, but if there's something you want to add or push back on, that's fine. Obviously, we don't want to get too caught up, though, on just one question. So at some point, I might just suggest we take the question offline at a later point, but just want to encourage people to push back if they want to. So with that, let's get into the Q&A. So who wants to ask the first question? Oh, while hands are going up, maybe I'll just say as well, I think Nate mentioned there's a few questions from the internet. So we might do a kind of like a 2 from the room, 1 from the internet type thing. We'll see how we go. Great. Who wants to go first?
Hey, Rob.
Hi,
My
Jack.
question for you, a lot of the businesses, or a significant chunk of the businesses in your portfolio, I would say it seems like you're underwriting a specific underwriting skill at the underlying portfolio company. And so I was wondering if you could talk about how you build conviction in the underwriting skill of something like a credit acceptance or Grinke or a PSG, and then how you would think about re-underwriting that in a moment of succession.
Yeah. Well, what a wonderful question. I've never really thought about it in that terms, but I think you're absolutely spot on that there's a strong level of underwriting at a lot of the businesses. So for those of you less familiar with insurance parlance, underwriting refers to kind of when you make a decision to allocate capital to a business, the underwriting process is that process of deciding, does this risk make sense? Is the return sufficiently high? And if I think of credit acceptance, the business you mentioned, they obviously make decisions about consumer loans. In Grenke, it's on business loans. PSG, who we just saw, they're obviously, Pete's main job is deciding which of the businesses should get capital, which is always scarce. And what I would say, I would answer the question in 2 parts, I would say. So I think you have companies which I'd put PSG in that bucket, maybe AdLife as well, where there's a handful of very big infrequent decisions. So Pete probably, I would guess, only makes 1 or 2 big capital allocation decisions a year, if even that. And so for something like that, I think understanding the character and the ability of the individual is absolutely crucial. And then if I contrast that with, say, a credit acceptance and Grinke, for example, they're making thousands, tens of thousands of loans every year. And so there has to be a system in place which can just sort of crank out those underwriting decisions in a really an automated way. So obviously you want to have a sense that that process works, that the process is protected by entry barriers. So if I think about credit acceptance, the wonderful thing about that business is the way they ask the dealer to participate in the risk of the loan. And that's it's really an incredibly powerful idea, because it's very difficult to replicate, because the dealer doesn't get the check up front. The dealer might only get the check sort of three years down the line, in which case they really have to have confidence that credit acceptance is still going to be around in 3 years. So when a kind of a startup comes along and says, hey, we want to copy credit acceptance, you just have to kind of, don't worry, my check's going to clear in 3 years. Obviously, dealers are very skeptical, and I think really nobody has really managed to replicate anything like credit acceptance as business model. So there it's more process-driven, I would say. But even there as well, no matter how good the process is, it's only as good as the people who kind of are running it and believing in it. And it's there too, actually, it's absolutely crucial that you have a strong culture with where people believe in the process, where integrity is writ large, where there's a feedback mechanism to the CEO in case things are going wrong or things can be improved. So even there as well, having said how important process is, I would say the people is by far the most important thing. Thanks.
Can I ask one?
Of course, yeah.
On the succession point, so for the PSG type businesses, obviously you're focused on succession of a few key individuals, but what about for the process and kind of monitoring? Is that eroding or is it maintaining its strength over time?
Generally for businesses or?
For the credit acceptance and Grinke specifically, kind of where you're trusting a process to make your underwriting decisions, but the world changes, the process has to change as well.
Okay, let me take the succession part first and then come back to your second part of the question. And if I miss it, feel free to say so. So succession is a kind of an interesting one for me because when I'm looking at a new business, I think I would never invest in a company which has a relatively new CEO. That's not because some new CEOs don't turn out to be superstars. You know, every great CEO at some point was a new CEO, I guess. But I just feel it's way outside of my circle of competence if some, shiny sort of graduate from Bain or Goldman Sachs or whatever decides he's going to turn his or her hand to managing a company. They might be great, they might not be. I just don't feel I bring anything to the table in understanding that. So as a rule, I'll only ever look at a very seasoned CEO in an ideal situation, a CEO who's the founder of the business or at least dedicated a very large part of their lives to that business. Now, the one exception to that would be in the case of a succession. So were at some point, for example, at PSG, Peter announced he's got a new guy who's going to run the business. I would hope it's someone internal, and assuming it's someone internal who has spent a lot of time there, I would for sure give that person the benefit of the doubt. In fact, we had the situation with Grinke where Mr. Grinke stepped back about 2 or 3 years ago, and he was taken over by Ms. Leminski, and that was a situation I felt very comfortable with. So I would distinguish a little. So I would say, as a rule, it has to be a very seasoned CEO. But in the case of succession, if I'm invested in the company and love the company, I would for sure give them the benefit of the doubt. And then I'm not sure I got 100% the second part of the question, but on process, obviously, the world and technology and stuff doesn't stand still. So the competitive dynamics and all this kind of stuff is permanently in flux, and it's. Obviously, as an investor, you want to be underwriting those changes and making sure you're keeping an eye on them and thinking about them. But the reality is there's so many things happening in the world. There's so many smart people starting businesses, being innovative. I think it's very, very tough to really judge that. So I would say from a bigger picture point of view, what you want to kind of be thinking about is the moat or the competitive advantage underlying that process, is that kind of moving, is that widening? Is it getting better over time? Or is it kind of deteriorating? Because even if it's a very small rate of deterioration, that's going to be a big problem if you want to be invested in a business forever. I kind of use the analogy of, 2 rowers on Lake Zurich, and they're in this sort of race, and one rower is miles and miles behind the other one, but he's going very, very fractionally faster than the guy in front. Now, in a very long period of time, obviously, he's going to catch up and take over. You might not know when, but you know for sure it's going to happen. So what I would really look to is that the moat is kind of widening. And, how can you tell if the moat is widening? I think some businesses, as they get better, the moat widens. Amazon, for example, on logistics and pricing power and stuff. Or if I think of our portfolio, to stick with the example of credit acceptance, they're gathering more and more data. The relationships with the dealers are becoming more longer. The dealers understand the product better and more incentivized to keep working with it. So I would say those are examples of businesses where the moat is getting wider, and that's probably the most important thing. Does that answer the question? Or?
Thank you.
Great. I saw a thumbs up. Thank you. And Alex, there's also from an Alex a question here next. We can give him, then we can keep things going. Yeah.
Hey, Rob. Thanks.
Hi, Nick.
So Jack's question actually brought to mind a question that I've had for you, which is, this is Nick Hyatt with UVA, just to introduce myself. Question is, I've noticed over time how your circle of competence has expanded. Mm-hmm. So you started investing primarily in German companies, and then you expanded to more global businesses, and more recently you've added acquisitive companies to your portfolio. And noticing that a shortcut you had used, historically may have become less relevant, given that your circle of competence had, I think, expanded. And so my question for you is, where are there places today you are learning and maybe seeing that your circle of competence is expanding, and places that you're focusing on, or are there shortcuts, for instance, the shortcut to not invest in new CEOs that could maybe one day become less relevant for you and your portfolio?
Yeah, that's a great question. Thank you. I'm just thinking, actually, while people are asking questions, whether someone wants to move the camera around just so we can see who's asking as well. I don't know if that's going to be... No? Okay, then in that case... No, okay. My technical guru says that's not possible. Sorry for the people on YouTube. I can promise there are actually people in this room. I'm not a schizophrenic. Okay, so I'm going to answer the question in a bit of a roundabout way first, then come back to it. And recently, I'm embarrassed to say it took me so long to get around to it, but I read Nicholas Taleb's book called Anti-Fragile, and in there he talks about kind of making mistakes as being a great source of information. And he actually specifically mentions the example of the Titanic, where obviously an awful tragedy, but probably contained information at the time about how big a ship should be built, and then that feedback mechanism meant that probably saved a lot of lives as well. And so I think as investors, we tend to view mistakes as kind of something to be avoided. To the extent they do happen, it's kind of okay, so. And Taleb in Anti-Fragile argues actually mistakes are something you should actively look out for because they contain information, but obviously they shouldn't be mistakes that in any way cause long-term harm. And if I relate that back to your question on circle of competence, I think there's a sense that you should never ever go beyond your circle of competence. But I think you should always be testing the edges of it, and to the extent you do test the edges, you're inevitably going to every now and again go beyond the circle of competence. And provided that doesn't kill you, then I think that's a great thing to do. How on earth are you supposed to expand your circle of competence if you don't ever kind of push the edges a little bit? And so I think it's something I've unconsciously always been doing as an investor, is trying to expand that circle of competence. When I started out, I was working in a sort of a small German bank in Germany, and I think the first 5 years of my investing life, all I ever looked at was German small cap companies. And if you look back at the Business Owner Fund when it started, I think 9 of the 10 companies were small cap German stocks, and there was like a 3% position in American Express or something like that. But it was basically there. And obviously, if I fast forward today, it's much more diverse geographically. It's also much more diverse in terms of the sectors that I'm invested in. So, I think that sort of expansion of circle of competence is super important. But it has to be obviously done in a way where, to the extent you make a mistake, it's not going to kill you, and so that's really important. In terms of areas where I'd like to kind of expand more, I think it's, to be honest, a fool's game to, if you think about this, kind of imagine a stock exchange with 1,000 companies, and you would have the ambition to sort of take all of these 1,000 and divide, the great managers from the bad managers. I'm almost certain if I tried to do that exercise, the result would be completely random. I don't think I would be better than average at dividing that up. And that's the reason I wouldn't, for example, start trying to analyze every type of manager. I've discovered for myself a niche of managers where I think the odds are just massively, massively stacked in my favor. And that's managers who've kind of turned the business into their life work. So they oftentimes are the founder, but sometimes they're just people that have spent their whole career there. Sometimes they might even be someone that arrived a little bit later, but clearly buys into the culture in a very powerful way. And that is the kind of the pool that I fish in. And I think it's a very, very rich pool, especially for a concentrated fund like me. I only have 10 stocks, so I don't need to have a view about all 500 stocks in the S&P or all 10,000 stocks elsewhere. So that's not an area where I push my circle of competence, I would say. But where I certainly would be into areas which are kind of new geographies, so places like China and India I'm very interested in. Have a certain skepticism as a non-Chinese speaker. How good am I going to be investing there? But I think that skepticism is good. It kind of hopefully protects me from mistakes. At the same time, I think it's an exciting market I'd like to do more in. So places like that I'd like to expand into. And I love also discovering new sectors as well. So in my most recent letter, I described the macadamia farm. You can see James looking at me there. Obviously, I'm not going to invest in a farm or a farming business, but I do enjoy understanding the economics of how new businesses or businesses which are new to me work, and so that will also be an area of circle of competence expansion, I think. Yeah.
Thank you.
Thanks. So we'll take from Alex and then maybe one from Nate and the internet. Yeah.
Could you talk about what leads to a sell decision? And particularly, I'd be interested on price. Like, let's say Wicks doubles tomorrow, nothing else changes. What do you do? You said it was worth $200.
Well, I maybe answer generically about when I sell, and then maybe come back to Wicks a bit later or afterwards. But for me, I've had two types of sell decisions in my career. The first type was where I was super enthusiastic about the business, thought everything was going exactly as I hoped it would, but then the PE all of a sudden seemed a little bit too high or whatever. And whenever I sold that type of company, I always regretted it afterwards. The company, any of those companies which I sold, for example, Hemle, it's a small cap German stock which I sold because I thought it started looking a bit expensive. And I think it's up about 5 times from where I sold it, and it's also paid about a 10% dividend yield as well. So whenever that type of sell decision, I've really regretted. The ones where I thought, the business is really not as good as I thought, or there seems to be a big risk on the horizon which I hadn't thought about when I first invested. Whenever I've sold something for those reasons, I've generally not regretted it. So if I look back at the fund, I owned Havisco, which was a wine distribution business. I thought it wasn't properly cognizant of the risks and opportunities from the internet, and I sold that. And I think the share price is probably roughly today where it was when I sold. And Baidu as well, as an example of a company which, when I invested, I probably thought it was sort of like a Google type business, and in reality it probably wasn't. So those are the two types. And then so if the second part of your question is about relating that back to price, and specifically to Wicks, I wrote in the letter I thought it could be worth 200. So what would I do if tomorrow it was trading at 200, right? Well, first of all, I think that's a high-class problem to have. It's not the thing that keeps me awake is that things double more quickly than I hoped. That would be fine. But I think relating what I described about keeping great businesses and then putting that into a valuation framework. What I wrote in the letter was, I think about 25% growth in Wicks up until 2024, and then of course I assume stability, and then I discount that back, and I got to 200. Now in a year's time, with any luck, there'd be a decent perspective that it can continue growing after 2024, maybe to 2025. In which case, if I assume those same 25%, all things being equal, that stock will be worth another 25%, because the earnings power goes up by 25%. So, I think there's a kind of a mathematical rationale to holding businesses. And also the other thing I would say is, so when I invest in a company, I'm kind of hoping for a 15% return on per year over 5 years, so a double every 5 years. And if, like the double happens in year 3, assuming everything goes well, which is of course not always the case, but assuming it were to happen in year 3, and then maybe you kind of have a flattish performance in years 4 and 5, and then hopefully the compounding starts again. I think that's fine. I mean, if you want to build long relationships with companies and not be trading the whole time, I think that's a financial sacrifice worth making. Thank you. So there's one down the front here, or you've already. We'll take one from
the internet. Yeah, one about PSG. How do you decide to hold the holding company as an investment rather than looking at owning the underlying subsidiaries?
That's a great question, and one I thought about a lot as I've had the privilege to meet a lot of the guys who run Capitec, and it's an incredible business. And when I invest in PSG, I probably spent more time studying Capitec than PSG, because Capitec is actually where most of the value of PSG is at least seen through today. But it was an easy decision to invest in PSG rather than in Capitec, because what determines the success of the Capitec investment will always be what happens at Capitec. I think that's obvious. Whereas at PSG, it will participate to a large extent in whatever good things happen in Capitec. But the rocket fuel on top of that is you have someone like Pete there who can take the excess capital out of Capitec or out of any of the other areas and reinvest it into the Capitecs of tomorrow. So I think it kind of should turbo boost the returns of PSG even versus Capitec. So in the last 2 years, that hasn't been the case. Capitec's share price has done better than Capitec's share price has done better than PSG. But if PSG functions well as a holding company, which I think it will, then I'm pretty sure on an economic basis, in 10 years' time, PSG will do better than Capitec, and at some point that will be reflected in the share price as well. Yeah, if you have the microphone, just stand up and ask.
Hey, Rob.
Hi,
Dennis Hong from Boston. My questions revolves around your interactions with management and the meetings. I'm just kind of curious, how often do you aim to meet with your management teams, and what do you hope to get out of those meetings? And then the second question, on a related question to that point on management meetings, what are some of the most thought-provoking, most illuminating questions that you might ask to a manager, and what are some of the interesting responses you've gotten over the years?
Okay. I'm not very good on multi-part questions, because I always forget the second one. So I'll take the first one first, and then maybe I'll ask you to ask the second one. So I think it was what I look for in managers was the first part, or how?
No, but how often do you meet with them?
Oh, how often?
And
Okay.
what do you hope to get out of those meetings?
Right, got it, yeah. So the research phase for me is very intense in terms of contact with the managers. So there would typically be lots of telephone calls, at least one in-person meeting. In the case of PSG, I think there were 2 before I invested. And that kind of period is very sort of intense. But once I've made the investment decision, I'm quite happy to kind of let them run. I don't want to be too kind of interfering. I would typically, I make a promise to myself, and I guess to my investors as well, that I visit the companies at least once a year to check in, see how things are going. So I would say subsequent to the investment, it would typically be a kind of an in-person meeting about once a year, and then I would, normally after the quarterly results, I would do a call as well, just to kind of see how things are going and that kind of thing. The really interesting part of your question is, what do I kind of look for, I think. And there, I think I do something which is a little bit different to what I see a lot of my peers do. So if I'm sitting in on a meeting where there's other investors in and they have the manager in front of them, what I find is they tend to ask questions about the business and the competitive advantage and the growth plans and all this kind of stuff. And I think those are important questions to ask, and they're ones that I would for sure make sure I've figured out the answer to before investing. But if I have the opportunity to sit down with a Pete or one of the other CEOs of the companies, those aren't really the questions I want to discuss, because I'm sure Pete has been asked a million times what the competitive advantage is of Capitec or whatever. So I'm just going to get an answer which I could have got from pretty much anyone. So what I really want to do when I sit down with a CEO is kind of try and figure out how they tick, what motivates them, how they think about the business, what their long-term plans are, what the story of the company is, how it came to be the way it is, because understanding the past is often the best way to understand what the future. So I would really spend a lot of time on those type of topics, and it might well involve talking about stuff which is unrelated to the business. That's also, it will oftentimes as well be in a non-business situation. So it might be going for a walk or meeting at my home or something like that. So location would typically be non-business related as well. So I would say those are some of the things I do. And the single most important thing I look for, though, is whether I like the person. And it seems like a strange answer in a value or for a value investing or any kind of economic scenario, because you're supposed to be very objective in making investment decisions or any kind of financial decisions and stuff. But I think as human beings, and obviously we've been we started evolving 100,000 years ago on the savannah, and I think whether you like someone contains an enormous amount of kind of information in terms of how we made it, survival on the savannah and that kind of stuff. It tells you whether those person's values align with yours, whether they think about business the same way as you do, whether they treat people fairly. It contains all of this unconscious information. And if you ignore such a rich vein of information, I think you're kind of you're missing an incredible opportunity. So I would say that's something the key thing that I actually look for.
And then do you have any thought-provoking or illuminating questions in your interview toolkit? And what do you often typically get as an interesting response, or have you heard of any interesting responses from those types of questions?
Yeah, to be honest, it's not really my style. I don't think there's any magic questions out there, and if they were, they would be asked so many times that the CEO would think up a good answer to it, and then it would lose its value. So nothing spontaneously kind of springs to mind. But what I really do, if you were to sort of sit in on me with a meeting, and many of the people in this room actually have done that with me, I'm just a curious guy trying to figure out what the business does. And I just sort of see where the conversation goes and try and understand. Oftentimes when you're new to a business, there's things you don't understand, like how do they sell and what makes the product special and all that kind of stuff. And so I'm just really trying to understand, a bit like at the macadamia farm as well. And then out of that, kind of new questions come up, and you start building a sort of a mental model of how the business works. And so that's kind of the way I go about things. But I don't really have any magic questions. And I sometimes cringe when people say, what keeps you awake at night and this kind of stuff. Yeah, if you're in a meeting with me, please don't ask that question.
Thank you, Rob.
Thanks, Dennis.
Maybe a direct follow-on from
Yep.
the internet queue, going back to the question about what you're looking for and wanting to have some sense that you like the person and the alignment of values. Have you experienced personally any false positives where the charm and charisma of someone has, overwhelmed otherwise bad behavior, lack of alignment, lack of business acumen?
Yeah. No, so I'm not looking for kind of charisma, and I think that's maybe some of the mistakes people sometimes make is, if someone shows up in a Ferrari in a very nicely cut suit and white teeth and a firm handshake, that this is my kind of guy. That's really not what I'm looking for. I prefer it if someone is sort of a little bit kind of scruffy and introverted, and so I wouldn't necessarily say I've ever been hoodwinked by charisma writ large. In fact, the opposite, that kind of turns me off a little bit. But I have made mistakes in judgment, and one that springs to mind is a German company called Hornbach Holding, which is a kind of a DIY business in Germany, a bit like, what do you call it in the US? Home Depot, yeah. And Hornbach is owned by the Hornbach family. They're the major shareholder in it. They've and it's a Mr. Hornbach who runs the business, and he's been in the business forever. He clearly loves it very much, and he's basically the kind of guy I like to invest in, and indeed did invest in. But it didn't work out as well as I hoped. The company has a huge amount of cash on its balance sheet, and then even issued debt and to have even more cash. So I think nearly sort of half the market cap was cash or something. And that doesn't bother me. I know a lot of people say, well, that seems very, very inefficient, but I kind of quite like it when companies have reserves, and then when opportunity comes along, then it's great to have financial strength when others don't. But in the case of Hornbach, they had this cash for 10 plus years, and then the financial crisis came along, and some of their competitors went bankrupt, and you're like, okay, now is the moment. Now you can put the cash to work. And he didn't. And to my knowledge, he still hasn't. And I think he's a great guy. But he has a very wide shareholder basis made up of family members. And my sense is, and I hope I'm not being unkind to him, but my sense is his kind of biggest fear in life is kind of screwing up, and hear all these terrible stories about how business gets screwed up in the third generation and stuff. And so what I thought was a positive attribute in his high stake in the business and long-term view, actually, in hindsight, I think it was sort of preventing him from making good capital allocation decisions, and that was the reason that was a company I owned. I think many years ago I sold it 5+ years ago, and that would also be an example of a company I didn't regret selling, and where I think I got the management underwriting wrong. But having said that, I don't think I've ever, at least not to date, including investments that I've sold, ever invested in a manager where it turned out to be a huge fraud. And I don't think it's even come close. And I don't think that's because I'm so talented. I think it's because I pay attention to it. For example, Pete mentioned earlier Steinhoff, which was a Stellenbosch company, which does seem to have been managed by a crook. And when I first went to Stellenbosch, I asked a friend of mine what he made of the Steinhoff guys, and his response was, "These are guys that I wouldn't, give my wallet to." And then he sort of told me some anecdotes about how they'd been using private jets to ferry family members to various sporting events and all this kind of stuff. And as soon as I heard that, the deal was off. I'd never even visited Steinhoff, let alone considered investing it, even though it was right next door to PSG, I think. So I think just by kind of paying attention to, are these guys crooks or not, I think you can dodge a lot of bullets. And you might then ask, oh, well, if it's that easy, why don't other people do it? And I think it's because they just don't really pay attention. And even worse, I think they might even view those characteristics I described as even maybe being a bit positive. Some people maybe have this mental view of the world that, it's tough out there and there's a lot of crooks, and it's better to be a kind of you can't avoid the crooks, so you may as well have the best crooks on your side. So this guy Marcus Euster, who ran Steinhoff, I think people knew he played hard and fast with the rules, but they actually liked it, and they were actively sought it as opposed to actively trying to avoid it. And so I think that's actually something that's worth bearing in mind. Yeah. Okay, there's a question down here as well. So, but you've got the microphone, so and then Brian, and then maybe the microphone in the front. Okay, you're in charge. Okay, good. I'll stop intervening.
Hi, Rob. Thank you for hosting this great event, and
Thank you.
Also I really appreciate that you so openly answer our questions. My question is about insider trading at credit acceptance. And I noticed that a couple of insiders that they sold their a bit of their stake over the last 1 or 1.5 year. So for example, Brett Roberts, the CEO, sold I think 3% of his stake, and Tom Triforos and Mr. Vasaluso, I think he's called, which are board members and important investors. They sold about 8% of their stake over the last 1 or 1.5 years. So I would be interested in whether you know or whether you have an idea what their motives are, whether it's because they want to diversify or whether maybe the stock is overvalued. I don't know. So I would be interested in your view on that.
Yeah, I mean, it's really something I wouldn't pay too much attention to be honest. I remember when I started out in investing, there were these websites which kind of tracked insider buying and selling, and I used to follow those as a way to generate ideas. But I really don't think it's worth paying attention to, and even if it was, it's just so much more important to form your own opinion rather than sort of worry too much about what other people are thinking, because, who knows why they did that. In the case of CEOs, they often have to sell to meet the tax liabilities out of their option programs. Tom Triforos is someone I know very well. He has a very deep connection to the company. If you tell me he sold 8% of his stake, then I can tell you then that probably means that a very large portion of his net worth is still in credit acceptance. So it's really something I don't think about and wouldn't pay too much attention to be honest. You have to have your own opinion. And if you don't have your own opinion, you're always gonna panic when the share price is down and stuff. So yeah, it's not something. And I know Tom quite well, and I wouldn't even ask him why he did it if I were to meet him. Yeah. It's his own personal business.
Hi, Rob.
Hi, Brian.
Question about the fund constituents, the stocks. It's been pretty stable for about 2 years till now. Correct me if I'm wrong. I don't remember
You
it.
mean the investors in the fund, or?
No. Sorry, there's the holdings.
Oh, the holdings, yeah.
The holding company. It's been pretty stable. I don't remember anything being sold since Novo, and I don't remember anything being bought since PSG, I think, until Wicks.
Okay, so I've caught you out because you clearly haven't read my most recent letter.
Skims, yeah. Okay. So,
I can always
anyway.
hide the $100 note in the letter when I send it to Brian. I know it's going to be safe. Yeah.
Very good. Right. So Wicks, right? You've decided.
You did read it then. Okay.
Yeah. Skimmed, as I said, like always. So you decided to buy Wicks. Presumably, it's because you thought the return on the appreciation of the valuation will be more than the average of the rest of the fund components. This time, it seems, from the way you answered the question earlier about it, that you've got a 4 or 5 year horizon on that. In the past, you would be speaking in terms of a stock you'd be happy to have in the fund, maybe lie in a coma for 10 years and wake up, and basically you would still be happy with that position. With Wicks, what do you see its moats are, really? And if I'm right, why only 5 years, and that then the connection with the moat, really?
Yeah. Thank you for asking that, because hopefully I can maybe correct a sort of a misperception. So when you value a company, you just want to kind of figure out in an obvious way possible of whether that's cheap or not relative to what you're paying. And and sometimes you can just do that on this year's earnings. So if, let's say, you find a stock trading on a 15% free cash flow yield, and you think it should be trading on a say 5% or whatever, so it's worth 3 times what you're paying, then that would you could just stop the valuation exercise there. But it doesn't mean to say you're not thinking about what happens in years 2, 3, 4, 5, and 6 or whatever. And so I think the reason I chose a 5-year kind of DCF on Wicks was simply because there was no need to go any further in the future to kind of justify the price that I'd paid. But for sure, I have a view on obviously. Clearly, I hope it's going to do really well, far beyond 2024 and beyond. So I wouldn't say that that's an indication that I've sort of suddenly become more short term in my thinking. Did you want to push back on that? Or? Yeah, I was going to come to the moat now. Yeah, so so I described earlier how important it is that companies have a widening moat or an increasing competitive advantage, and I think Wicks is a perfect example of that in all kinds of respects. So the best competitive advantage increases over time as a rule when there's kind of positive feedback loops. So you're doing something, and because you're doing it, you're getting better, and because you're getting better, you're doing more of it, and so you get into these positive feedback loops. And Wix has tons of those. One of the ones I like the most is they make software to make DIY websites. So you can imagine, especially in the earlier days, it was a very simple tool to get content published on the internet. But if you needed additional functionality, so let's say, for example, you're a restaurant and you want to take bookings on your website, perfectly reasonable use case. and you can't do that on Wix, then clearly you would then go to a professional website builder and say, hey, I would like to get restaurant booking functionality. Can you program that for me? And then it would probably be done on WordPress. But Wix tracks very closely which websites aren't being completed on its software and the reasons for it. So at some point, I guess they kept seeing all these restaurants who started building the website on Wix and then kind of abandoned the process, and they reach out to them, what was the functionality that we were missing? And they say, hey, we really wanted to take table bookings on our website. And so over time, it kind of adds, and then the percentage of of businesses which can complete their website on Wix increases over time. And that's really been the development of the company over the last 10 years. They've added more and more functionality, more and more verticals, so industries like restaurants or hairdressing saloons or fitness instructors, you name it, adding the functionality these type of businesses require, so they're able to convert more and more of their users to Wix customers. So it's an amazingly powerful feedback loop which feeds the product development pipeline. But it even goes further than that, because obviously, if you're able to convert 20% of the people that click on the Google link to your website building software, and your competitor who has less of the verticals or less of the functionality is only converting 15%, then you can bid more for that Google AdWord and win more customers, which feeds back then into more data into your product development roadmap. So you have all these kind of flywheels working in the same direction, and there's many other ones I could probably mention as well. So it's a company where I really feel I'd be amazed if the moat wasn't substantially wider in 5 years than it is today. Are you happy with the answer? If you want it, you can say. I know. Okay, good.
Yeah, let's take
Cassandra, because she was already standing up, and then we'll take one from
Sure.
there.
Sorry. So my question is, it touches on the culture and succession, but it's obviously finding a great manager who has invested a large part of his life, dedicated a large part of his life to the company is great. But what kind of features do you look out for? And based on your experience, our testimony that this culture permeates deeper than like the top layer of management. What kind of features do you look out for?
Yeah, got it. So I think in terms of the manager, there's not actually specific features I look for, because there's all kinds of successful managers that could have completely opposite characteristics. So you have someone like Steve Jobs, who has this reputation for being very hard driving, shouting at people, all this kind of stuff. And then the other end of the spectrum, you have people who are very humble, understated, almost introverted. So it's not like I'm looking for a set of characteristics in the CEO. And it doesn't really matter what they are, because to the extent they're the founder of the business and the business has become successful, then it's because of those particular characteristics in combination with that company that it's become successful. But the interesting part of your question is then, okay, but then how do you check it's in the culture of the company? And there I think there's actually quite a fairly simple way to go about doing that. And that's that, a culture in a way is like an operating system for a company. So it's like if a company has a culture, so a way of doing things, and then something happens, in an interaction with a customer or when making an investment decision or whatever, and it's not in any kind of rule book what the employee should do, but by referring back to the culture, they can kind of figure out what the right thing to do would be. Then you know that the culture really permeates the organization. And so the way to find that out in practice is just to talk to people in the company or in the organization, just not with any particular agenda in mind, just about what they do in certain situations, how they think, and then you can find out pretty quickly whether the culture permeates an organization. I thought a great example of that was actually I visited Amazon 3 or 4 years ago, and I just met the investor relations guy. I think Jeff Bezos was unfortunately otherwise occupied. He apologized, but no, I'm joking. And I asked what I thought was a really good question. Unfortunately, I don't even remember what it was, and I thought I was going to stump the guy. And it was, in fact, a question he hadn't heard before. But then he sort of went back to first principles. Okay, what would the customer want? And you could see this sort of, he was going through this sort of mental sort of checklist of what would the customer want, what would be the best thing to do. And he basically from first principles, from the company's culture, got to what I thought was a really good answer to that question. I thought that was a great example of where you can really see that the culture permeates a business. And I also feel that a lot when I go to credit acceptance as well. It's a business where they're in a very tough business lending, subprime auto lending. They're just permanently just trying to get a little bit better every time, take a little bit of cost out, make processes a little bit more efficient. And there you as well, you see just this permanent feedback mechanisms in the company of sitting down, of talking, of setting priorities, of improving things, and then next week going back and doing it all over again. So I think you do feel when you spend time at the company talking to the employees whether the culture is real or not.
So this is a follow-on to the questions about Wix, maybe digging down a layer or two deeper. It's a fabulous business, but they also compete against some fabulous competitors like Shopify, Squarespace. It's a big TAM. There are well-capitalized businesses trying to attack it. How do you think about the competitive set and Wix's position to gain incremental share among an otherwise very innovative set of competitors as well?
Yeah, I think I would push back a little bit at the premise of that particular question. So I think if you were to go back 10 years ago, there were tons of really big successful companies which had some kind of web building software. So, I think Adobe had a tool, Microsoft had a tool which was bundled in Microsoft Office. Google had a tool, all kinds of other companies as well. In Germany, I know there was a lot of local players with tools and stuff, and a lot of them have just fallen by the wayside because you just have this relentless pressure to improve in order to be able to convert customers, and so a lot of the supposedly strong competitors over time have really fallen by the wayside. But if I relate it back to those companies in particular, I would say the standout company in those three companies you mentioned is Shopify, which is obviously a fantastic business. But the good thing there from a Wix shareholder perspective is there's really not very much overlap between the two. So I think Wix have said that type of retail e-commerce is about 5% of their subscriber base. And if it's a very small business which maybe started with a regular website and wants to add a little bit of e-commerce functionality, then that might be a good Wix customer. But to the extent someone starts out planning to do an e-commerce website, then I would say that they're far better served by Shopify. And I spoke to the Wix guys about Shopify. They think very highly of the company. They really don't want to compete with Shopify in that e-commerce space. So, but like I say, I don't think there's too much overlap. And then the other two companies you mentioned, which was Squarespace and which was the other one, or another smaller player. I would say these companies are, especially Squarespace. It's smaller. It's much more US focused. It's much more focused on the design vertical. I would say there's plenty of space for more than one player in this market, but I would feel much more comfortable being a Wix shareholder than, for example, a Squarespace shareholder. Yeah. Do you want to add anything to that, or is that okay? Good.
Hey, Rob.
Hi, Dan.
You could find a really capable management team who are honest and they have a business that's got a great culture and the business has outstanding unit economics and dominates its market, and et cetera, et cetera. But I wondered if you may have some ethical red lines that you're unwilling to cross. And there's a long laundry list of sectors and businesses that attract kind of negative ethical questions, from fossil fuels, firearms, gambling, whatever it might be. Yeah. How do you think about that?
Yeah. Thanks for the question. It's something I do think about a lot, and there are a few sectors that I would never invest in. And what I kind of think about is that, am I excited to be an investor in this business? Do I like the people running it? And so if the business is kind of, in my view, unethical, then I'm unlikely to be excited to be invested in it, and I'm unlikely probably to like the people running it. So that would be really out of bounds for me. And the big ones there, which I would for sure avoid, are gambling. I think it's a terrible thing. It's shocking that it's so pervasive in the UK. I was over there at Christmas, and like almost every second TV ad is for gambling. I wouldn't ban it because it would then just it would go underground. But I'd make it as difficult as possible for people to gamble. I would not, only permit shops in seedy, out-of-town places where you have to really go out of your way to get there. It would forbid any kind of advertising of it. And I think it's a huge mistake that the UK is making in allowing that sector to thrive. And there's a few other sectors as well, which I'm not particularly keen on. The one exception to that list of yours, which is, some people might have a different view of this, but I'm just going to put it out there, is I really, with this whole ESG trend, this idea that people that produce fossil fuel are somehow immoral or unethical, I find that frankly disgusting. I mean, our entire, we rely on fossil fuels not just for energy, but for fertilizer, for food, for the tractors that drive the farms and stuff. If these people who put their lives at risk to drill for oil in dangerous places were to suddenly say, okay, forget it, I'm not going to do it anymore, our society would grind to the halt and we would all starve within probably a week. And the people sort of take a high moral stance that these people are somehow unethical and doing the wrong thing. I don't share that. I understand that the climate is reaching a tipping point, and we need to reduce our reliance on fossil fuel. But we should then, that's up to us as individuals to do that. Let's not blame the people that put their lives at risk to find the fossil fuels. Yeah. There was a slight clap there, and no booze, I have to say.
Rob, you've spoken in the past how alignment's more important than financial incentives for managers. So this pertains to Wicks. I think we found our new Facebook for the meeting. We got Wicks. So the question is there, stock compensation runs 10 to 12% of revenues. So where in that spectrum between incentives and alignment does that lie? And more, I guess, lower level, I think you mentioned roughly a 30% free cash flow margin. How does the stock compensation play into that? Because that's a real expense for the business.
Yeah. Okay, thank you. So thank you for drawing attention between the difference between alignment and incentives. I think it's an important one which people kind of oftentimes miss. So there's this sense that incentives are kind of unbelievably powerful, and I think Charlie Munger has said something along the lines that he's understood incentives better than anyone else on the planet, and even he underestimated them. I only agree with that point to an extent. All the times you see incentives kind of misfiring, it's always in the kind of the negative, where people do something completely wrong and irrational because for some, the incentive program was misconstructed, and as a result of that, they did this sort of really bad behavior. The flip side, though, that people actually do great things because of financial incentives, I really struggle to think of any examples where that's the case. If you think about a sportsman like Roger Federer, serving for the final set of Wimbledon to win the championship, I'm pretty sure that the prize money is not top of mind in that situation. And I think it's true for great managers and actually also regular employees as well. They achieve great things when they love what they do and they feel they're being fairly compensated for it. So I do distinguish between an incentive and an alignment. But your question was more around kind of wicks in particular. And if there's one aspect of the investment case I'm less keen on, it's that the management don't have particularly large stakes in the business. They have significant stakes, but not the very large ones that I find in some of my other businesses. And as a result of that, I think for them, the stock-based compensation is a kind of an important component of creating that alignment, so that to the extent the business does really well, that they can participate in that. So it's something I'm slightly less keen on. But that being said, there's a lot of other kind of positives that kind of far outweigh that. And then in terms of valuation, you're right to point out that stock-based compensation is a big kind of component at the moment. But I think there's a few things to bear in mind there. The business is still hugely profitable. I think on the free cash flow is, I think, something like 27% yield, including stock-based compensation. If you take stock-based compensation out, it's 3 or 4%. So there's a big delta. But I think they're investing about 30% of revenue, or even a bit more than 30% of revenue in marketing and that kind of stuff, and costs which are investment in nature rather than just to keep the business running. So I think even today, and even excluding stock-based compensation, you're still kind of getting pretty close to that 30% free cash flow margin on a steady state basis. And of course, over time, you have to invest based on what you think the future is going to look like, not on the present. And it's still a very young, fast-growing company. Over time, as it becomes a little bit more mature, you would expect and hope that the stock-based compensation becomes a much more smaller component, and that's kind of what you see everywhere. If you look at Facebook, 5 years ago, I'm sure you'll find that this SBC was much bigger than it is today, and ditto for companies like Google and stuff. Yeah. Okay. Chandon.
Hi, Robert. Thanks for having us again this year. So my question is not about investing per se. So with each passing year, I kind of have more and more money. And I look at my kids and I kind of wonder.
That's what happens if you keep putting one foot in front of the other and you and you spend less than you earn. And yeah.
So the thing that worries me the most is I have now 2 kids, and I want to raise them to be responsible, humble people, and not spoiled by the money they probably are going to see in their life. And I wonder, what are the big decisions you make in your life in raising your children, which you think one should pay attention to so that they actually become responsible? Thank you.
My daughter's looking at me as you ask that question. I really think there's only one thing you can do as a parent if you want to create those type of outcomes, and that's set the right example. I think children don't pay too much attention to what you say to them, but they do unconsciously copy the behaviors and the things you do. And so if you want your children to kind of grow up humble and with a proper respect for money, I think the only way to do that is to demonstrate that yourself. I've had the fortune through my work to meet a lot of very, very wealthy families and their children. And what I've amazed to see almost every time is just how humble and down to earth the kids are. And the reason for that, I think, is simply because that's the way the parents live. They have regular cars, they live in regular houses, they take regular holidays, the kids go to regular schools, and so it's just second nature to them. It's based on what they're experiencing and versus what their parents are telling them. But as I was answering that question, it occurred to me that this was when I had dinner with Charlie Munger. This was one of the topics that had the most attention, because there was a couple of other guys in the room who'd been very successful venture capitalists and it was very much top of mind for them how to stop spoiling their kids. And there was an interesting discussion because Charlie said, you have to give your kids lots of money, because if you don't, they're going to end up hating you, or sufficient money. You can't. I think he said, that you. Olivia prefers Charlie's answer, I think, to this question. No, I think his exact words were, if you kind of artificially try to keep them poor, they're just going to end up despising you. And it was interesting because afterwards I was reflecting on that response with some of the other people who were in the dinner. And we kind of came to the conclusion that it reflected on the environment the kids were growing up in. So in the case of Charlie's kids, they were growing up in LA, which is a very polarized place, I think, between rich and poor. And if you're in this sort of very rich environment and all the kids are driving kind of Porsches and going to private school, and you send your kids to, the public school and don't give them a car and stuff, understandably they're going to be excluded from their social circle, and that will probably be a very unpleasant thing for them, and they're probably going to end up hating you. But I would contrast that to kind of bringing kids up in, for example, Zurich, where we both live, or in Germany, which is where a lot of the families I've learned are. And there you have a much more kind of egalitarian sort of society where the kids all go to the same public school. There's not such a big difference between rich and poor neighborhoods. The families themselves, even if they are rich, tend to kind of hide their wealth, or at least not show it off. So maybe there's a different opportunity for people like us as wealthy people bringing our kids up in Zurich or in Germany than, say, in LA.
Thank you.
Okay, anyone else? Do you want to take one?
Yeah. Nate, do you have any? Or?
Sure. This is one that came from the web. How do you prioritize reading or doing work on new businesses versus the businesses that you own, and how has that allocation of time changed over the years?
Yeah, so what I'm most excited about is actually learning about new businesses. And what I found over time is what works best for me is sort of doing the thing which I'm most excited about, because then I'm kind of enthusiastic about it and motivated to do it and that kind of stuff. So I would say quite a large part of my time is actually on reading and studying new businesses. And that's also partly because once I've really sort of made up my mind to invest in a company, I'm really not waking up every morning and rethinking that decision. I know there's some investors that advocate every morning you should sort of mentally assume your portfolio is 100% cash and then each day sort of reset it anew. That's just not my style, because if I were to do that, then obviously the portfolio would be turning over like crazy, and I wouldn't be able to build these long relationships that I want to build. So, so I guess I probably spend much more time on new business than the old ones. But in terms of the old businesses, I always obviously read the quarterly reports more out of curiosity than I'm really expecting them to change my mind. And when new kind of risks or opportunities come up, I like to discuss those with my fellow investors or with the management of the company. And like I say, I visit the existing investments at least once a year. I speak to them several times a year. So that's kind of how I would allocate my time, I would say.
Hi Rob, my name is Asaf. I came all the way from Israel. Wicks is the headquarters really next to my where I live, and I know the company for a long time. So the question is obviously about Wicks. So I was wondering, actually, even before you bought it, we had a model for the company, and we tried to compare what the set of assumptions that you took comparing to our set of assumptions. And it was funny to see that in year 2024, Wicks will have, actually under your assumptions, will have to add another Wicks of 2019 in order just to maintain the same rate of growth. And all this while on the backdrop, you can see that maybe sites or websites are becoming less popular when you have Facebook pages and maybe other solutions like maybe apps for your phone. And I kind of feel that maybe there are some vectors that going in the opposite directions. Maybe websites are becoming less popular, and then you actually have to in order to maintain the same rate of growth, you have to actually maybe make them more popular. So I was wondering, how do you actually view the TAM, the total addressable market, and on how it develops with time, and what do you think it will be in 5 years from now?
Yeah, so my sister's looking at me. She runs a social media marketing agency, so she might want to make a comment on to what extent people still want to have websites. But I'll let you think of your answer, and I'll maybe respond first. So, I'm not a great. I would take those forecasts as directional as opposed to kind of point. As long as things go very approximately in that direction, I think the investment will work really well. But don't hold me captive to them exactly. But as you correctly say, I have a 15% subscriber growth, which means a doubling every 5 years. So in 5 years' time, it should double versus where it is today. I think at the moment they're adding about 800,000 new users a year. So 800 times 5, that would be the 4 million. So I think it's not completely unreasonable, but we'll see what happens. But in terms of TAM and stuff, I think there's a few things to bear in mind. The website costs like $15 a month, right? And you throw it up in a few hours. Even if 90% of your clients were on Facebook, which I'd love as a Facebook shareholder, but unfortunately I don't think it's the case. Even then, though, it'd probably still be worth having your own website so you don't miss out on that other 10%. And I think a website as well, it's a calling card. It shows you're a serious business, a bit like how perhaps in the past having an office signaled you're a serious business, even if perhaps you didn't necessarily need one. So, I think there's lots of reasons to do it. And also, like I think I mentioned earlier, it's also not just a website with content nowadays. Oftentimes it's a kind of a tool to manage the business, with reservations and all that kind of stuff for restaurants, or it has chat functions if you want to communicate with customers and stuff, because people hate picking up the phone nowadays. So if you have a chat or that kind of stuff. So, I think there's lots of reasons why people will continue to have a website. But Alex, do you want to say something on it?
Yeah, It's also, we find the first thing when we look at a client now, if they want to come to us and do like Facebook advertising or social media marketing, the first thing we now look at is their website, because we use the website as a lead funnel, as a lead generator, because people are more likely, we find, to leave their contact details through a website than they are through a Facebook lead form. And the leads that we see coming through websites tend to be more genuine and thought about than people just quickly clicking on Facebook. So I still find websites to be massively important. I can't see it, not being something that would be phased out, personally.
Yeah, I think actually I would almost argue that things could go in the opposite direction. So, Google is under a lot of attack in Europe because a lot of the kind of companies feel they should be featured more prominently in Google search results, whereas increasingly Google, serves up the direct answers people are looking for. And so the thrust of regulation in Europe is that, these companies should be more prominent in Google. And it's kind of instructive to compare that with China. In China, the dominant companies, in my view correctly, have gone the complete opposite route. They forbid Baidu to serve or to scan their websites and serve results from onto the search engine, because they want the customer directly. They don't want to pay a tax to Baidu to win the customer or to serve the customer. And so if I was running one of these businesses which are suing Google and want to be more prominent in the search engine, I would actually advise them to go the complete opposite route and to really try and force those direct relationships with clients rather than the other way. And of course, having a website or an app is the best way to build a direct a relationship and not have it intermediated by a Facebook or a Google. And and I say that as an investor in both Google and Facebook.
Hi, Rob. Just a question on SaaS business models. So, as you looked at Wix, were there any particular characteristics of SaaS business models that helped you kind of sort the wheat from the chaff there? Customer retention, the nature of the market addressed. Because clearly they're really, really powerful business models, and that's why they trade so highly. So maybe if you're comparing a Wix to an Avalara or something like that, that's a very specific, sales tax type SaaS model. If you were doing a deep dive in that sector, would there be particular characteristics that you might look for in finding opportunities in that pond?
Yeah, for sure. I mean, it tends to be the case that all SaaS companies get thrown into the same bucket, and they all get sort of this 10 times revenue sort of bandied about and stuff. And the reality is there's huge differences between SaaS businesses. So from my perspective, by far the most important feature is whether the customer or rather the revenue churn is positive or negative. If you lose revenue over time through customer churn, then obviously that's a much worse business than one where just every year, without you doing anything, the revenue just keeps kind of coming in. So I think that's a very important difference. And I also think the gross margin of the SaaS business is also an important feature. So, in its core business, Wix has over 80% gross margins. So pretty much, a large part of that revenue gets converted into cash flow for shareholders. And wonderful though Shopify is as a business, a big part of their revenue is through payments, and payments is quite a low gross margin business. So a Shopify dollar of revenue is for sure not worth as much as a Wix dollar of revenue. I know I have a lot of friends invest in Shopify. I think it's a wonderful business. No need to remind me of that. But that's for sure. A difference. That's how I think about it. But the big point about SaaS businesses in general, which I really love, is the alignment between the company and the business. Like I described with Wix, the better the product is, the better it is for the customers, and so it just really aligns beautifully. And it's the case for a lot of SaaS businesses actually. Whereas historically, software has been like just an attritional warfare between the customer and the company. Oracle, it would lock you into its database software, and then at the end of the quarter, if the sales guy hadn't made his numbers, he'd sort of drop by and say, "Listen, there's a 10% revenue price increase. Otherwise, we're going to, kind of cut you off." And so customers then had to kind of swallow the bitter pill, and there was like this real hate between Oracle and its customers. And in SaaS, it's actually the complete opposite. The number one goal of a SaaS business is to reduce churn, and the best way to reduce churn is to have happy customers, so you have much more of an alignment, and I think that's a really powerful flywheel for the sector as a whole.
Thank you.
Hey, Rob, thanks for hosting.
My pleasure.
Question about your meeting with Charlie. Did you talk to him about China at all? I know he's pretty vocal about his interest there, and did that conversation, if you did it help you improve your circle of competence or increase your confidence in investing in China? And then also, if there are any other, like, you mentioned there were some follow-ups you wish you could have asked him. If you could expand on any of those, I'd love to hear what you were interested to learn from him as well.
Yeah. No, I mean, he said on several occasions that during the dinner that he thinks that kind of the future is in China, and I really, really agree with that. And given that that's where a lot of the economic growth is going to come from, it makes sense that that's where the best investment opportunities are going to come from. He speaks very highly of the fund manager who he outsourced his capital to, Li Lu, I think his name is. He mentioned Li Lu several times. I think the way Charlie thinks about China is that at a high level, he thinks it's an amazing opportunity, but the best way to address that is through someone who's closer to the market than obviously he can be as a 96-year-old. So I would say his comments on China were quite high level, so not necessarily something new, but it was nevertheless interesting to hear that. And in terms of pushback, there was quite a few things. Actually, one where I actually did push back a little bit, which was quite interesting, and I think I got a really good response, was he was saying how, and this is maybe a slight negative for Berkshire shareholders, but how, even with the benefit of hindsight, he doesn't see how, going back 5 years, how Berkshire could have beaten the S&P 500, given in its sort of sweet spot of the type of businesses it likes to invest in. They've sort of underperformed the market, given its size constraint, given the amount of capital it has to invest, and given that it wouldn't invest in sort of FANG type stocks. And I did actually push back to that response, because I said, Charlie, over 5 years ago, you spoke incredibly highly about Google, and as far as I can judge, you seem to really kind of have a great understanding of it. So are you really sure it was outside of your circle of competence in hindsight? And his response was actually quite sweet, and he said, Rob, you have to understand, I don't even have an iPhone. So I guess maybe it is a little bit outside of his circle of competence, if you don't have an iPhone. But I guess that's how humble a guy he is, that he has this amazing understanding. But just because of something simple like not really interacting with an iPhone and being familiar with that kind of stuff. Yeah. Is there one from here, or there's also one chap in the front here who's been putting his hand up a few times. So do those two and then maybe come to the front. Yeah.
So a simple one, but an open-ended one. What is currently your greatest challenge as an investor?
I think it's the greatest challenge is and we're almost at the beginning of January today, and no matter how great last year's performance was or the last 10 years' performance was, every year you start back at zero. And not only do you start at zero, but you have new investors coming on who have absolutely zero benefit from what happened in the previous 10 years and are only interested in what happens in the next 10 years. So you really just can't sit back as an investor, and the things that worked over the last 10 years by definition aren't going to work the next 10 years, because capital markets are very efficient. As soon as an opportunity crops up, people are onto it very quickly. And so you really have to just sort of be thinking things through from first principles every day and the start of every year, and you just really can't sit back. And I think that's the challenge. On the one hand, not to become complacent, obviously, but also to actually think of new things you can do. Right? I think I've spotted over the last 10 years some inefficiencies in the market, in particular, focusing on these people who make businesses their life work. Maybe switching to some tech-type companies earlier than the value investing community as a whole did. So, I think I found things in the past to do differently, which helped the performance. But, the game starts afresh every day, and that won't help for the next 10 years. So just have to kind of keep trying to think of new ways to do things and find opportunities. Hi, Stefan.
Yeah, I'm not sure if I will get the question right. So I've known you now for more than 10 years, and one of the things that strikes me is you're very independent in your thinking, and you don't hesitate to give pushbacks to Charlie Munger, for example, or any idea that we actually exchange or whatever. You will always have your own independent view, which is essentially why you have some of my money.
Thank you.
Yes, and on the other hand, you also, we're all here because we exchange ideas, and you actually make the exchange with other people a big part of your life. And so my question is kind of, how do you maintain those two areas, like your independence in thinking and this exchange with other people? Yeah.
Yeah, it's a great question, and I would say in a nutshell, it's really by not hiring anyone. That would be the short answer, but I can give a longer answer as well. So, I'm if the people that know me, not a super strong personality, I would say. So, if I'm in a group or a team and someone feels very strongly that everyone should go in one particular direction, I would probably be someone, even if I thought that I had a better idea, to the extent that person seems so kind of enthusiastic about it, then I would probably sort of fall into line and do the same thing. And so what I kind of realized quite early on is if I were to hire a team of very kind of successful and self-confident people around me, then probably over time it would be the team's ideas which would probably find their way into the portfolio rather than my ideas. And so that was really a big reason why I decided not to hire analysts in particular. But having said that, it's just so incredibly important to exchange ideas with other people like we've done and a lot of people in the room here. And what I found is that if someone is a peer, so someone who's managing their own money or managing a fund or whatever, you can have a much more open, relaxed conversation than you can with an employee. So with a lot of the people in the room here will have talked about stocks together many times in the past, and I might have had one view, they might have had another, but then everyone goes home, they build their own portfolios, they might have bought the company I liked or sold it, and I'm not offended, they're not offended. It's really very uncomplicated. And I would contrast that if you hire an analyst, and the analyst spends a month studying a company, they get super excited about it, they come into you, they explain why this company is the best thing since sliced bread, and then if you say, actually, this is not something I want to buy, then they're like super disappointed, but okay, I'm going to go back and try again. So then next month they work super hard, they're getting excited, they're burning the midnight oil, they find this great idea, they come and present it to you, and you say again, yeah, I kind of like it, but this is not what I'm looking for. Now they're actually starting to get a little bit frustrated, and what is the point in all this hard work if it never makes it into the portfolio? So probably the third time they come along and say, they've done this work and they'd like to buy something, that you're probably at that point going to fold and say, okay, you can allocate a little bit. So for me, what's worked spectacularly well is making decisions by myself, where it's just me, there's no distraction, there's no one I have to kind of push back against or fight against. But at the same time, having that very rich network of wonderful investors who I can exchange ideas with in a very kind of relaxed way. And the person I've exchanged ideas with more than anybody else over the last 15 years is Andreas Lechner. Andreas, are you here? There he is. He's an incredible investor, and I'm going to be interviewing him tomorrow, so you'll meet him tomorrow. But as preparation for our talk, we had a conversation which we haven't really had before, which was about our personalities and how we got to where we were. And Andreas actually said something quite similar. One of the biggest challenges, sorry if I'm actually taking some of the message from tomorrow, but maybe it sets the scene for it. But he was also saying that he finds it very difficult if someone's a very senior type person with a lot of experience, a lot of success, to kind of make decisions against that person. So I think for him as well, it's worked well to kind of have the opportunity to engage with other people, but also to have a certain distance as well. But that's just a little foretaste of the discussion tomorrow.
Hi, Rob. Thanks for hosting us. I'd like to ask a little bit about what's not in your portfolio.
Mm-hmm.
So the question is really, how many businesses do you look at a year, and how often is price the determining factor that you decide not to go ahead at that point, such that it becomes something maybe for the watch list or the reserves? And then maybe more generally, what do you think is the biggest factor behind errors of omission for you?
Yeah, thank you. So I think that was the first part, how many kind of companies I look at. I look at a lot of companies in the course of the year, but a lot of them are really only very kind of quite superficially. If someone says an idea is good, and then I'll start looking, at very simple things like the type of business it's in and tenure of the CEO, and then a lot of businesses get dismissed after less than 5 minutes work. So there's probably tens, if not hundreds, of that type. But in terms of ones which I really start to do much more work on, I would say it's probably more like maybe 5 to 10 as opposed to, the hundreds of the more superficial type analyses. And I think you said and then the reason that I study those 5 or 10 is generally nothing to do with price. I most likely haven't even valued them at that point because I probably don't have a view on how to value them. So the reason to focus on those 5 or 10 is that I'm really excited about the people running the business and the opportunity that lies ahead of them and all these type of qualitative type of factors. And it will really be towards the end of the process that I feel confident enough to value the business, and then we'll maybe start thinking about what it's worth. And to the extent the price doesn't seem super attractive, then I'll most likely just put it on the watch list rather than invest in it. So I would say that's the kind of the biggest trigger. And then the second part of your question, just a quick reminder.
I think the errors of omission, what do you think is the most systematic factor that if you look back that you could change?
Yeah, so certainly it was a kind of a misconception of how to value a business. So I kind of think if I go back maybe the first 5 years of the fund, I kind of thought if a business was, I know it sounds silly, but if a business is trading on 20, 25 times this year's earnings, then it's just not a value investment. And I mean, that's clearly just a spectacularly wrong mistake, and you need to be thinking about what type of earnings power business is going to develop over the next 5 or 10 years in order to figure out whether something is cheap or not. So that was certainly the biggest source of error, and one that I think I kind of corrected, but I missed some really good opportunities, especially in the financial crisis, probably just because I was a little bit too hung up on paying a really low multiple. Did I cover everything? So I know there were a few different parts to your question there. Yeah. Okay.
These are the last two.
Okay.
Yeah. Just a quick note too, we're getting pretty close to noon.
Okay, yeah. So maybe I think 2 more people have microphones. So.
These two are the last two.
Okay, we'll take these 2, and then is there anything else on the internet or? Okay, so these are the final 2. No pressure.
Hi, Rob. I'm James from New York. Thanks for letting me in off the wait list a few months ago. As someone who obviously holds your managers in high regard, and you have a strong sense of what type of manager you like to back, and you do a lot of work in building relationships with these managers, how do you protect yourself from potential confirmation bias where you've already built a relationship, you have a strong rapport, but maybe the world has changed and maybe the business has changed? So to answer that, maybe I'd love to hear you riff on some cases where you've had to make a hard decision about that, where you've done a lot of work and haven't underwritten yet, or you've backed someone for a long time, but maybe you have to make that hard decision.
Yeah, thanks for that question. So that kind of goes a little bit into kind of emotional biases, and the one you specifically called out is kind of confirmation bias, which is where, because you've said or done something in the past, you kind of feel beholden to continue doing it the same way in order to be kind of consistent, and that's called confirmation bias. And I really feel that these type of biases can be harnessed to your advantage as opposed to being viewed as a source of risk. And I think I mentioned in my most recent letter that I might talk more about that in the future. But if you think about it specifically to confirmation bias, the fear is really that people hold on to companies for too long, that they ignore warning signals when they maybe shouldn't have. And my sense, though, is that although in theory, yes, that is a risk, The far bigger risk and the far bigger source of mistakes for investors is actually a lack of confirmation bias, where they're actually not holding things as long as they should do, where although they might plan and set out to be long-term, they actually end up selling a company after a few months or whatever. And if I think about some of my biggest mistakes, it's actually been selling things too early rather than holding them too long. So I understand where the question is coming from, but I actually view confirmation bias as perhaps an opportunity to live up to the long-term kind of holding periods that you're hoping to. And also like in very difficult market phases where maybe stocks are under pressure and stuff, using that to your advantage to be able to ride out the storm, because you kind of have that strong confirmation bias which is sort of keeping you in there. So I view it for me more as a kind of an opportunity than a risk, but I agree that under certain circumstances it could be a risk. I'm trying to think if there's anything I've held too long because I ignored negative signals. Nothing really major springs to mind. Novo Nordisk was, I could have sold it much more early, but it wasn't really confirmation. It was just because I'd missed how important raising prices had been to their earnings growth, and when that disappeared, the company obviously became much less valuable. But I don't think it was a confirmation bias, and actually I was more than happy to sell when I kind of realized that I'd made that mistake after the share price recovered a little bit. So don't think it's been a major source of error, but maybe that's my confirmation bias, which is hiding that information from me. So I think there's one last question. Yeah.
Yes, hi Rob, and thank you for the event. So I have a two-part question about your job as a fund manager. I wanted to ask if you feel sometimes like a bit stressed from investors when you have maybe like a month or a quarter that is doing not so great, that they is starting to speak with you and call you and ask a lot of questions. And the second part question is, from all the funds that I have seen over the last 10 or 12 years, you are probably the one with the best track record that I could find.
There's a few better ones out there, but thank you.
Okay, so probably I couldn't find them, but I saw like a lot of funds with a poor track record that are managing 5 billions, 10 billions, 20 billions. So the question is why you have like such a great track record and you have not like raised 5 billions, 20 billions and so on. Thank you.
Yeah, it's. I mean, there was a few different questions in there, but the last one on why am I not managing 10 billion? It's just not my benchmark for success. I know a lot of people view the best manager as being the one with the most assets under management, but I really disagree with that from deep down. I think the best manager is the one who has the best track record, and having too much assets is actually really a hindrance to building a track record. And
but you have there's not investors that want to invest with you, so you have to say no to them, and you have to tell them no, make sure you have enough money.
Yeah. No, I have to say no to a lot of investors for various different reasons. I don't want to have too much capital, so some of the very large investors will say something along the lines of, our endowment is so huge, our minimum ticket size is 200 million, and I don't want 200 million from just one single investor, so I have to say no to that. I have to say no also from an organizational standpoint, because I don't have any marketing personnel. If I take someone as an investor, I'm the one who's going to be building that relationship with them, and I only have a certain amount of capacity there's only a certain amount of relationships you can lead, so obviously I really try to select the people I like the most and want to spend time with as a kind of a criteria. So there's lots of different reasons, and it's just not scalable what I'm doing, right? So there's just, it's only me, I don't plan to hire anybody else. So I'm only going to ever manage a small amount of the world's capital, and that's perhaps also one of the reasons I'm very happy to support emerging managers, because I'd much rather the money went to them rather than some kind of hotshot New York hedge fund or Fidelity or whatever. So that's kind of how I view it. But you also asked about stress as well, which I think is an important one. And as hopefully you can see, I'm not stressed. I think my wife and children would confirm that. And that's really because it's a conscious decision not to be stressed. If I think there's an investment which would make me stressed in the sense that I'd be up at night thinking, oh my God, is something going to go wrong, then that for me is the clearest possible signal I shouldn't be invested in it. So that's also an example of where I kind of use emotional biases maybe to my advantage as opposed to having them as a risk factor. So if I think something is, if I'm not sleeping when I think about an investment, then I would clearly sell it, yeah. Yeah, well, so I can, a lot of my investors are in the room now. I'm looking at a few of them in the front row here, and I can really say I've never once ever had a stress call from an investor because one of the companies had some kind of problem. It's just never happened. And that's obviously because I think I've selected investors who really understand what I'm doing. And it doesn't stress me either, because if I'm invested in 10 companies, there's always going to be quarters that are bad. So if a company has a profit warning this year, and most likely there will be one of the 10 that does, it wouldn't surprise me. I don't beat myself up on that. Of course, there's not going to be, there's always going to be things. That's not an example of a mistake. It's just part of it. So so my investors has never been a source of stress. My one small caveat would be where I do sometimes get emails is from non-investors. So people, I guess, who don't know me so well, maybe read my letters, and then Facebook might be down 20% on a day because there's some kind of negative scandal announced, and then someone who I don't know will email me saying, "Oh, Rob, did you see the Facebook news?" And I'm like, "Yeah, you could probably guess that I did see it." And then they want to know what I think, and I'm like, I want to, I really don't enjoy that kind of email, because I kind of think that person should be thinking for themselves, and especially if it's a smaller company, what I'm thinking in that moment is potentially a very valuable source of capital money for my investors, right? If the stock is down 20% and I think it's an amazing opportunity, that I don't want to be trading. I don't want to be telling people what I think, and also the other way, if I think there's a real problem with the company, then obviously I want to be selling, and I don't want to advertise that I'm selling. So I don't really appreciate that type of email, and so I'd really advise people. I don't mind if they use my portfolio as ideas for their own portfolios. It's a perfectly reasonable thing to do, but they have to be clear that they're making their own investment decision, and if there's a problem with one of the companies, they have to decide for themselves what to make of that, and whether they should buy or sell. Yeah. So that's kind of how I think about it. Yeah. Great. Well, thank you very much, everybody. I don't think there was a single question on Facebook this year, which is incredible when you think about it, which doesn't bode well for the Facebook investment, but anyway. So I recommend it's a beautiful day out there. I recommend heading up to the mountain, and I'll see you back here at 6 p.m.